The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Let's take a look at an example on this particular chart in front of you. We have a clear, definable trend. The market has moved from these high points down to this low point over here. If we just simply follow price action of this resistance level here, we can see that the market moves lower, finds support, begins to move higher again, once again finds resistance, that's in line with the downtrend, travels down to this particular low over here, only to then find a good area of support that eventually pushes prices up to similar levels around the previous corrective high. We then see price action move lower, and more importantly, fails to move lower to generate a fresh trend low. Instead, we then subsequently see prices move higher. Now, at this stage, when prices start to move higher, if you've followed price action in exactly the same way that I've just done, perhaps you may even want to draw in these straight lines or overlay them onto your chart price just to give you a more clearer graphical representation of price action. You can very much clearly see that all we are doing is we're seeing the opposite of what we just looked at in the previous example, which was something along the lines of what I've just drawn at the top of the chart. We have shoulder 1 on the left, shoulder 2 on the right, and we have a head in the middle. By being able to observe this pattern, known as an inverted head and shoulders pattern, we can start during this period over here to focus our attention on the greater probability or the increased chance now that the market is actually in the process of reversing a downtrend. Therefore, what that does is it places us in a position whereby our directional bias could be changing. We understand, however, that we're not going to preempt any patterns in the market. We're able to draw our neckline. In this instance, will simply be the resistance points marking the two shoulders. And on a confirmed break of the neckline, we will then in turn have a confirmation of the inverted head and shoulders pattern, and then by extension, confirmation that market sentiment has switched from bearish to now bullish. In other words, if this is a market that we want to trade, we need to consider long positions. So our thought process during this phase over here would be potentially getting ready for that outcome. What we then notice is price action does indeed move through the neckline. Therefore, the inverted head and shoulders pattern has been confirmed. Our outlook now is bullish. It's bullish during this phase, and it will still be bullish even on the basis of this pullback. Let's consider a few other additional points. Because our view now is bullish, we have three options that we could consider from a trading perspective. We could either have gone long once the neckline was broken, or we could look to buy dips. The third strategy means that we could also consider buying a breakout of the bull trigger. Very important two terms in terms of observing here, the risk parameter and the bull trigger. Once the neckline is broken, we need to identify where our key risk parameter is. in a head and shoulders environment, when you see this pattern, the right shoulder, in this instance we're dealing with an inverted head and shoulders, the low point of the right shoulder marks the key risk parameter. This basically means that for this pattern to remain valid, we need to see price action hold above the risk parameter. If price action instead does move below the risk parameter, then it has the effect of negating the entire pattern. And we then need to abandon the logic that we have just taken on board, or the conclusion that we've just taken on board, and reassess price action once again to come to another viewpoint. So, very important that you identify your risk parameter, and it is always going to be the low point of the shoulder in an inverted head and shoulders reversal pattern. For a reversal pattern following an uptrend, it'll be the top of the right shoulder. Therefore, if you had opted to go long on the break of the neckline, your stop loss would have been below here, the initial stop loss. You need to assess whether the amount of risk that you're going to take on board is a viable option. The other point, or the other strategy, is to look at buying dips. You then subsequently see price action move lower. During this move lower, you may say to yourself, I will calculate a predetermined level that I would be happy entering a long position at, and once again with the stop loss against the same risk parameter. The third strategy is to say, I have not been able to either consider or not comfortable with taking a position through either strategy 1 or 2. What I'd prefer to see is for the market to firstly confirm that it is holding the risk parameter and then start to climb higher. If it starts to climb higher, I know that the next bull trigger is the subsequent highs that have been generated following the break of the inverted head and shoulders. In other words, that will be my trade consideration in terms of buying the breakout of the bull trigger. Let's assume that this is your low. This will then become your new risk parameter. So we're just illustrating over here how you can take the information that you've gathered from the analysis that you've done on the market, and you can come to 3 different possible strategies around which you can base your decisions. Whether it's 1, 2, or 3 doesn't necessarily suggest that any of them are better than the others. It's very important that with respect to each strategy, you understand where the risk parameter is, because then you can gauge the decision making around the risk parameter. And that is your head and shoulders pattern. We'll now move our focus on to double tops and double bottoms. Now, the underlying behavioral element of price is exactly the same in terms of what we looked at with respect to the reversal patterns. On the left hand, on the chart that you have in front of you, we have an uptrend defined by a sequence of higher highs and higher lows. The main difference is that when it comes to double tops, instead of seeing a head and shoulders type formation, which perhaps would look something along the lines of what I've just drawn over here, the activity that will highlight a change in market sentiment will follow something along the lines of what you see just below the head and shoulders. In other words, the market travels to a certain point, finds resistance, tries to reinstate the trend, is unable to, he once again sells off, and that ultimately provides a warning sign of a change in market sentiment. This is exactly the same kind of logic that we applied with respect to head and shoulders. We're just simply dealing with a slightly different formation. We can also highlight, when it comes to double tops, a neckline, possibly more commonly referred to as a midpoint. The break of the midpoint or the break of the neckline will confirm the double top. Again, if we take the height of the top, the highest point of the trend, down to the neckline, we can then project that distance down towards a level that can then be calculated as the price objective. So in exactly the same way as we saw with the Head and Shoulders reversal pattern, we can then also calculate a price objective based on that pattern, which would then facilitate the risk management aspect of our trading decision, and also highlight the risk reward potential on any trade that we may be looking to take on board. A double bottom is the exact reverse of the double top. We have to have seen a trend, so we can very clearly see a downtrend that is dominating during the sequence of lower lows and lower highs. The market travels down to this low, finds support, which forced prices up to that high. Once again, it tries to establish the downtrend, fails to make any headway below the last low, travels very close to it, and then subsequently pulls higher. On the break of the midpoint, we can come to the conclusion that we are now dealing with a sequence of lower lows and lower highs. Having broken the midpoint or the neckline, we can come to the conclusion that a double bottom has been confirmed and that the market will now most likely travel in an upward direction. The distance of the lowest point in the double bottom to the midpoint can then also provide us with a calculation of the price objective. Think about price patterns in exactly the way I have been interpreting and discussing them as price has been changing its course of direction. Let's take a look at a couple of illustrations. Because we're dealing with a reversal trend, we clearly have to have seen a directional move in the market. In this instance, we have a very clear uptrend. The market travels up to this point over here, finds resistance, once again finds support here, to then start its push higher and finds resistance at roughly the same level it did on the last attempt at that particular level. Prices are then subsequently unable to push higher and they begin to push lower. Now, if we were trading perhaps somewhere at this particular level, your observation as an analyst and your familiarity with the double top would give you an early warning sign that there could be a developing threat to this trend. The market has failed to break through these levels on 2 occasions. It is now moving in a downward direction. We are beginning to see what might indeed turn out to be a double top. In other words, there's a developing threat to the downtrend. I will focus my attention on the midpoint. If the midpoint is broken, then the double top is confirmed, and that will confirm a reversal. So the break of the midpoint in this illustration confirms a change in market sentiment or a reversal in the trend. If you are long, say you've been in a very fortunate position to have been long from this low over here, and I'll just mark that with an L. Let's call that our entry point on this trade. As price action has traveled higher and confirms a sequence of higher highs and higher lows, remember, you need to identify your support levels. Your stop loss would have been potentially at this level when price action was trading through this phase over here. Being able to identify at an early stage a change in sentiment potentially or a threat to the uptrend when price action fails to break or make any significant headway above this particular level on a second attempt and starts to pull back, you may say to yourself, I need to be more aggressive in my risk management and move my stop loss up to the midpoint, because if the market breaks below the midpoint, it confirms a double top, it confirms a bearish environment, and under those conditions, I do not want to continue holding on to a long position. So by making this evaluation early, you can also then more effectively manage any existing trades that you may have had on board during the cycle of the uptrend. Let's take a look at another example. Again, over here, we have a clear downtrend. Market has moved from those highs down to these lows over here. We notice once again that having traveled down to this particular point, the market then moves in an upward direction. We just summarize the overall activity by the market then having found resistance to once again start pushing lower. The subsequent recovery sees the market failing to generate a new low and then start to push higher. Because we are more familiar with a double bottom, we can now come to the conclusion that there is a potential bullish reversal threat to this trend. Our focus of attention will then be on the midpoint. The midpoint breaks, and that then confirms the double bottom. It then also confirms a change in sentiment. In other words, the market is now bullish. We then subsequently just monitor price action, and let's just assume that we are at this point, having traveled down to this support and then starting to move higher. The market is defining a sequence of higher highs and higher lows. Therefore, the key risk parameter now becomes these two levels. We see that price action moves lower and starts to move in an upward direction. We are able to identify our resistance, our key risk parameter, and therefore we can start to perhaps more effectively identify trading opportunities with the first objective in mind being this level up here, which is simply being calculated off the lowest point of the double bottom to the midpoint and then projected higher. So we are not just in this example applying our focus on the double bottom, we're looking at how price action behaves subsequent to the double bottom confirmation, and then that can provide us with information in terms of how we should be using that to potentially capitalize. In other words, look at taking on board trading opportunities. One final point I would like to make with respect to the objective, and this is relevant for both the double bottom or double tops as well as the head and shoulders reversal pattern. These objectives are generally seen as minimum objectives. In this instance, the objective might act as a resistance if price action does ultimately get to that particular point. The general view from a theoretical perspective is that ultimately prices will likely also move beyond that particular point. So objectives based on these two types of patterns are usually seen as minimum objectives. That concludes our focus on the head and shoulders reversal as well as the double top or double bottom. Triple tops, triple bottoms are exactly the same as double tops. They're just simply an extension or a longer extension of the exact same type of pattern behavior. What is the key reversal day? Now, essentially, the key reversal day is a pattern. It's known as in this instance, it'll be a bearish key reversal. It's simply a situation where you have a higher high, a lower low, and this is all in relation to the previous day, and ideally a lower close. You'll always have a lower close, but ideally below the open price of the previous day. In other words, in terms of its appearance, the key reversal day has a day's range that is larger than the previous day and has moved in an opposite direction to the trend that has prevailed up until that point in time. Key reversal is a unique pattern because it forms over a 2-bar period. You may recall from our discussions on candlestick analysis last week that the Japanese bearish or bullish engulfing pattern would be a very similar pattern to the key reversal. From a bar chart perspective, the key reversal is not seen as the strongest of the reversal type of patterns and should, however, be also then used in conjunction with other indicators to provide a greater degree of conviction around the pattern if and when you do see these types of patterns occurring. In terms of my own experience, I suspect for those of you who will start to look at reversal patterns is that you will focus your attention primarily on the head and shoulders pattern as well as the double tops or double bottoms. These are the ones that provide, let's say, a much more effective evaluation of a change in market sentiment. If you do include in your analysis Japanese candlesticks, which we used last week, the bearish or the bullish engulfing pattern that is used in the Japanese candlestick methodology is a much more powerful signal than the key reversal. Nevertheless, keep an eye out for key reversals. There are important reversal patterns. Just make sure you are applying perhaps an additional few filters through the use of other techniques to provide some additional confirmation on the signals. That concludes our focus on reversal patterns. We will now look at continuation patterns, and these will be made up of a review of triangles. We'll begin our discussion though with pennants and flags, and we will end the discussion with a look at the wedge. The difference in terms of understanding where continuation patterns and how they are made up of with respect to reversal patterns is that continuation patterns simply reflect a pause in the current trend. Because the market is in a trend, then it makes sense that these types of patterns will unfold over a shorter period of time. In terms of price ranges, they'll also cover less ground. So we'll tend to see shallower retracements. If we were looking at momentum studies, something that will be discussed in detail both tomorrow and on Wednesday, the momentum studies don't display any significant divergence from price. And this essentially just means that the market is still in a strong trending condition. Because we're just looking at the pause in the price action, once the pattern is confirmed, expect price movements to be impulsive, because this really just confirms a resumption of the trend. The best way to look at these guys is to look at some examples, and also just to bear in mind that if we think about the three phases of a trend, we can discuss this point now, is that typically we would expect to find continuation patterns in phase 2. That is where the trend has been defined. We would tend to find the existence or the development of reversal patterns instead in phase 1 and phase 3. Here's a good example of either flags or pennants, and we'll group flags and pennants together because essentially these reflect very clearly just the concept of the fact that the market is simply pausing for breath, so to speak, before continuing the underlying trend. We can see in all three of these examples, this would be a flag. Think of a flag, we'll look at it in upside down terms, as just what a flag looks like. Okay, so we've had a move down, and then we have a pause in price action, and ultimately then markets will move lower. Okay. This would be seen as a flag. A pennant takes more of a somewhat triangular formation, but you can see in all three instances the retracements in an opposite direction are shallow. They last for relatively short periods of time, and then the market is impulsive once they break out of the ranges that you can identify. I wouldn't suggest you look at these levels as specific levels. Simply, you're just trying to highlight the range that has been established by either the pennant or the triangle, and then once you observe that price action is breaking out of this zone, then that is a confirmation that the trend is resuming. So flags and pennants, typically we'd find these in phase 2. They are short-term pauses in the market's underlying trend, and they tend to reflect a degree of impulse in price movement once the patterns are confirmed. So trend resumes on the breakout of these patterns. The triangle. The triangle is a slightly larger pattern and is also a continuation pattern. When we talk about triangles, there are three types of triangles. There is the descending triangle, symmetrical triangle, and the ascending triangle. All three are continuations. We probably tend to find that symmetrical triangles occur more often than the latter two. But one point to bear in mind when we're talking about either descending or ascending is that these patterns perhaps give you some additional insight into a degree of confidence with respect to the market moving in a downward direction in this instance, because simply the market is finding support at the same level and is finding resistance at slightly lower levels. In other words, that basically means that as the market moves higher, the market is prepared to sell at that point. It moves higher once again, Those who are looking to sell rallies feel more comfortable that they are now prepared to go short at a lower level than previous resistance points. That gives a greater degree of conviction that the market will ultimately move in a downward direction. Likewise, in this instance, market is coming in to buy at higher levels on each opportunity. The selling level is exactly the same. That provides a slightly more bullish outlook to the pattern development. So we'll tend to see a descending triangle in a downtrend and ascending triangle in an uptrend. We'll tend to see both, or the symmetrical triangle in both an uptrend and a downtrend. All three triangles are continuation patterns. What do you need to bear in mind when you're dealing with triangle patterns? Here is an illustration of a symmetrical pattern, a symmetrical triangle, sorry. Important to remember that a triangle is a continuation pattern, so the break will be in the direction of the trend. When you're looking at a triangle pattern, we're not suggesting that you preempt the pattern. You wait for the confirmation. The confirmation in this example is at point X. In other words, when the market breaks out of the boundaries of the triangle. So that is the point where you could consider initiating a trade. Remember, like all continuation patterns, price action is likely to be impulsive, so breakout trading could be a consideration. But point X confirms the triangle, also confirms the breakout, and is the point you could then begin considering taking, in this instance, short positions. One very important point, though, to bear in mind is that the breakout of a triangle should be within the 50 to 75% area of the triangle's formation. And what do we mean by this development? If I were to just draw, hypothetically, price action continuing to trade within the boundaries of the triangle, it's very obvious that over time, price will move outside of the triangle, simply because at some stage in the future, the two lines will meet, you'll have the apex of the triangle, and price will move outside of that triangle. That is not deemed to be a valid triangle breakout because it is time rather than price that has taken price action outside of the triangle. The reason why the breakout should occur in this area, 50 to 75% of the triangle's formation, is that at point X, when the markets break, that tells you that price is breaking out of the triangle. And that's a very important development because it's a reflection of what the market is thinking. The market has now resumed its focus on pushing prices lower. So very important that price action, in terms of the triangle that you might be looking at, the breakout occurs at the 50 to 75% area of the formation. We can also calculate an objective based on the pattern, and this is simply the width of the triangle at its widest point, i.e. at this end point over here. You take the vertical distance, and then, my apologies, you project it lower at the point of the breakout, and that will give you an objective based on the pattern. So we have wedges, my apologies, we have triangles, we have pennants, we have flags. They all comprise continuation patterns, and the one consistent element that we should observe when the markets break out is that the movement should be impulsive in the direction of the trend. Here's an example of a triangle formation, which in this instance occurs at the tail end of a trend, but nevertheless you can see, very importantly, that the market is impulsive once it breaks out. Notice too that if I was to extend these lines, this is just a rough estimate, that the actual breakout occurs within the 50% to 75% area of the formation. You may recall this is a chart that we looked at earlier when we were discussing a double top. So very clearly here, in terms of what you have, is the trend is still very strong at this stage. The triangle formation gives us an indication that the market is likely to move higher. If I can follow my analysis around the triangle, I'll have an indication as to when to consider taking a long position in the direction of the trend. During this phase, because you're now also familiar with reversal patterns, your logic, this is a daily chart, over the next couple of weeks would begin to change in terms of focusing on the possible threat to the uptrend. Do I still hold on to my position, my long position based on the triangle? Well, if I do want to do it, then I'll place my stop loss below the midpoint of the double bottom, or sorry, the midpoint of the double top, which we discussed earlier. So that there is your triangle formation. The final formation that we will look at is a wedge, which is simply a triangle, however, where both lines are moving in the same direction and in an opposite direction to the trend. So the trend in this instance is up. We have a pause in the market's upward climb. We have an upward line reflecting that pause and a support line reflecting that pause, and they're both moving in a downward direction. One slightly steeper than the other, but nevertheless, that is what a wedge formation is. And again, in exactly the same way as we dealt with in a triangle, the breakout confirms a resumption of the trend. Also, the breakout should occur in the 50 to 75% area of the formation of this particular pattern. So a wedge formation is simply a very similar formation to a triangle, except that the two lines run in the same direction and in an opposite direction to the primary trend. We've looked at two very important aspects of technical analysis and two very important and powerful ways in which we can evaluate underlying market conditions. We focused our attention on reversal patterns and continuation patterns. Initially, we just recapped on some basic tenets of technical analysis. We discussed some aspects in terms of what we're trying to do with technical analysis. We then got a really good understanding of what the dynamics are, what dynamics are involved when we look at reversal patterns, what we mean by trend inversion. And then we looked at a few reversal patterns, the key ones being head and shoulders, double tops, double bottoms, and we concluded it with a key reversal day. We then went on to discuss continuation patterns, looking at flags, pennants, triangles, and finally ended our discussion with a focus on the wedge formation. Start to familiarize yourself with reversal and continuation patterns. These are very powerful tools in terms of getting an insight and coming to certain conclusions about the underlying strength and weakness that may exist at various intervals in a trend. In the next webinar, we will be looking at moving averages, introducing you to this concept. We'll be looking initially at multiple moving averages, the slope of a moving average, and discuss the elements of support, resistance, and lags that relate to moving averages. We will then move our discussion onto momentum indicators, looking at what overbought and oversold means, discussing and getting an understanding as to when overbought and oversold is effective, what bullish and bearish divergence is, combining overbought, oversold, and divergence, and then discussing how you can also apply more traditional methods such as trend lines and patterns in momentum. We will then conclude the webinar tomorrow by a brief discussion on the importance of time when it comes to divergence. Congratulations, everybody. You have now finished webinar 5 of the Advanced Technical Analysis course. Once again, I'd like to thank everybody for joining us. Our focus today was on price patterns. We'll be back tomorrow, and hopefully you can join us then. Thank you once again, and see you next time. Bye for now.